Oh, that's right.
Anwar, coming up, what are you pitching us?
Pitching Donnelley Financial Solutions.
All right, so we've got Donnelley. Talk us through, again, how you came upon it. Maybe what, here, I'm going to change up my opening a little bit. If there's some method that helps stumble on, what's the disruption you're finding, right? Whether it be the thing you did or how you're departing from the street. Start us off with what you can be thinking about, and then let's say Q&A. We're going to open our speech that way a little bit more. Either what are you departing from the street from, or what's the disruptive idea you have that you tried to quantify? Fair enough?
Yeah.
You guys remember the advice framework, right? What is the D in the advice framework? Differentiation. That's what we want to see, is differentiation.
I'm going to call it disruption because I like it.
Or disruption.
It's a D. Yeah.
Yeah, absolutely. So my name is Anwar Ahmed, and I cover domestic financials. So today I'm pitching Donnelley Financial Solutions, which is a company that provides compliance and capital market solutions and software. So really how my screening process, at least, to find this company was actually screening a lot of companies out. I was looking for more of a B2B type of business model. So it was really taking out a lot of consumer-centric type of companies and trying to focus in on some more business-to-business companies. This one seemed really interesting because they they operate in the compliance space, and that's not something I knew much about starting before. So I thought this would be interesting to research into. And so how I really differ from the street analyst is the company is currently doing a 5-year transition to a software centric business model that I believe the street is not really pricing in. Historically, the company was more of a charge per usage type of model. And so the street is still kind of pricing the company based on that model and is not really pricing in the shift to software. Currently, the street estimates are pricing software as 27% of total revenue, whereas my estimates are more towards 36% in 2023. So that's really where I'm differing from the street. Overall, my price target with all my evaluation methods is a $37.89 price target with a 9.11% upside. And I'm pitching as a hold just because my DCF kind of showed that there is a little bit of a lack of a margin of safety with the transition to software. So that's really why I came in with the hold. So I think I'll open it up to questions.
Great, thanks. So you mentioned that you don't think that the street understands this company's getting into a new, better, more stable, profitable business line. Because why do you think how many analysts cover the stock?
3 analysts.
3. So how do the 3 analysts, and I think one of them is a very quick question, so probably actually 2. So I'll give you credit. We have a small
one of them is Morgan Stanley.
We definitely will count them out. So what I really want to ask about is, why is management, whose jobs are dependent on the direction of the stock price, why would a management team not want to highlight something that they think is great about their company?
And this is a really great question. And when I looked into it, because the answer to that question is that management is pretty open about this strategy. It's mentioned in earnings calls. It's mentioned in investor presentations. It's mentioned in a lot of different places that analysts do have access to. But I think analysts are hyper focused on just where that transaction part of the business is, because the next quarter of earnings is usually pretty sensitive to that, because today about 50% of the revenue does come from that segment.
Which of the bad segment?
The tech-enabled services segment, which is the really volatile one. So,
right. So we'll call it the bad. The bad part. Well,
I don't want to call it bad.
But I think the way you were pitching to me is that this company's got this crown jewel. This thing's growing.
Yeah.
But it's got another part that's dying, a slow death. Another part that's okay. And I think what you're saying is that the analysts are so worried about the dying part of the company that they're not willing to take the time to really look at this crown jewel that's growing.
Right. So the dying part of the business is really that print and distribution segment, and the analysts aren't really too focused on that either. What they're really focused on is just the majority of revenue does come from this really volatile segment. So what they're really trying to figure out is the critical factors for that segment would be like how many M&A transactions are going to happen, how many IPOs, how many SPACs, how many restructurings, things like that. So I think I mentioned in my write-up, if you look in my research, in figure 4, I believe, is like how many times analysts were mentioning those words in their questions. They asked those questions 45 times that they mentioned those, and they mentioned software transition like 3 times. And when management's answering those questions, they do mention the software part of the business. But analysts are really focused because if you look at the earnings, just how they missed, I think I have that data here too, which is actually pretty interesting.
Well, why you look at that? It's a really good point.
No, it's right here.
That you're doing the sentiment around how many times people are asking about a question.
Yeah, and if you look at it, like so Q2 21, the company beat estimates by 65 cents. So which is a lot considering the estimate was 90 cents. So that's like, you know, a huge beat. And then they missed earnings the prior quarter by 13 cents. And then Q3 21, they beat estimates by 57 cents. And that's all really driven by that hyper volatility you saw in like M&A activity and SPACs. So all the questions that the analysts are really focused on that, and they're not really pricing in yet that change to software, which is.
Sounds good. Good. Thanks.
Basil.
Yeah, so I realized, like, going back to like how you're differing from consensus, do you have any time frame where you would change your recommendation from a hold to a buy or sell based off of that?
Yeah, actually, I think in the next year, if management kind of shows, and if the earnings show that the software transition strategy is actually coming to fruition and kind of hitting the target numbers that they said, the stock could potentially be a buy. But also, it is kind of important to realize that when I ran the DCF on like my more ideal circumstance, it does only produce like an 8% upside from that DCF. So it is, so if, you know, we live in a world where there's a lot of things that can happen. So if adoption slows down in future periods, that could potentially hurt the stock. So, or if they have to spend more in CapEx to try to ramp up software production, anything like that could really cause some downside. So that's why I'm pitching it as a whole, because I think we want to be in companies where if things don't work out as perfectly as that, we should have a little bit of room for error.
August.
Why do you doubt management's execution so much?
I don't doubt management's execution that much. Actually, that's not really why I'm pitching it as a hold. They've been pretty good about producing like innovative new product offerings and bringing them to market. They've been pretty good about that. So I think management is capable. I just think there's a lot of factors that play into this, and the DCF is not really giving me enough leeway to try to factor in like if something with adverse effects to try to price that in and still get upside. So I think that's really what my
One second, because I think we've departed from the heart, and it's going to lead to a lot of questions that'll take us down a segue since I worked with you, and I don't want to put words in your mouth. So I'm going to ask you some pointed questions, right? You've got 3 segments. You clearly think the street is wrong and the software segment should have upside. So if I sat in the room, and this is the first time I'm hearing about this, and the street can't figure out this other piece, it's very volatile. They're discounting completely this thing that's going away, and they're missing there's upside. Why isn't your DCF saying there's upside? It doesn't make any sense to me as a student.
Well, they're doing this transition, so really
How is the street? You're going on a tangent. This is keep things simple on the opening pitch. I know the answer to your question, but I'm going to drag it out of you and not give it to you. How is the street? Is the street too high or too low on that main middle piece?
so you're saying the software segment?
No, the main middle piece that's volatile.
Okay, the tech-enabled services segment. Are they too high or too low?
Yeah, the street.
I think the street is. I think they're a little too high on it, quite honestly.
Because they're too high there, even though this other segment they're wrong on, they're too low on. It's not enough to make up for it. Is that a fair assessment?
Yeah, no, because the company does have to still spend in CapEx to build up that software service.
So to get to the heart of your question, I think, August, is he trusts management, but he thinks the street is overvaluing that middle section because of the volatility, and that's not letting him get to a buy. Even though he thinks he found this really great segment that has growth and buy-side potential, the main piece is how much of their business percentage-wise.
Yeah, it's 51% of revenue right now.
And given that he thinks the street is a little too high on that, it doesn't matter what his other thing does for the next year. Does that answer your question? Now,
As the company shifts more towards the SaaS business, do you think, is that gonna stabilize the earnings a lot more?
Yeah, absolutely. That's why they're doing it really. Like right now, I think analysts don't want to put like a higher multiple on this company because they just can't predict what EPS is going to be in the future period. SaaS is a little more predictable revenue. So I think in the future, like we were going to see like earnings stabilize a little more and we're going to see like estimates like kind of hit their target more than just absolutely missing them or being like way above. So I think that's something we'll see in the future. Yeah.
A follow-up to that is, on the software and service business itself, what would be a more normal beta for that type of business?
That would be a good question. I didn't look too closer to what other software companies are trading at in terms of what their betas are. I certainly don't think it would be the 1.7 we see for this because that's really pricing in that volatility. So that's a good question. I would look at like companies more like FactSet and these other SaaS like companies that kind of serve the commercial like segment to see what they're trading at, and I would kind of put it somewhere around there.
I'm gonna follow up. That was some good questions. I appreciate it. What year is there a point at which this SaaS service equals the size of the company from a revenue perspective of this middle part of the company?
2024. Yeah.
Okay. So would it not be reasonable then to say in 2023, we might want to revisit this because if your thesis is right, looking forward a year with Dr. Valentine, I could now be pitching a 1.2 beta, which would give me upside alone. Plus I'd be looking at a company with relative earnings stability, even if your optimistic case doesn't come to play.
Yeah, absolutely. I think
Okay.
once we kind of see where that segment goes and if the story plays out, then definitely.
And that's something else that Dr. Valentine and I haven't talked about, but I'm very open, I'm sure he is too, to this idea of us starting to create a watch list with target dates for future analysts so that if you have a junior right now with you that's in your sector says, gosh, there's nothing wrong with going back and repitching what Anwar just repitched this year, saying, hey, Anwar had this idea and now I'm piggybacking, I'm cheating a little, but a lot of it came to fruition. And this earnings stability came out, and it turns out SaaS is now 51%, and this other one's 35%, and the analysts still haven't figured this out, and now it's time to buy it.
Yeah.
That's a great pitch, honestly.
Yeah, presuming you do some additional research.
Yeah, you're gonna have to do a lot of stuff,
Yeah.
but yeah.
Yeah.
I think that's a pretty reasonable way for us to proceed. So we can't vote on this, but I would appreciate you putting that kind of in your notes for your junior and giving them a target to go back and relook at it.
Yeah, absolutely. Assuming that Southside doesn't already kind of price that in.
They may all adapt, which they're smart folks, but it's worth taking a look at, right? Doesn't take long.
Yeah, definitely. I think that's a good idea.
Anything else? Well, thank you. Good luck on your interview. He front ran because he's got an interview. For some reason, we think those are important for you guys.
I just throw in just to follow up on this because similar, so this happened to Morgan Stanley when I was there. There was a CEO in the mid-2000s who was trying to get the company to be more of a brokerage firm because brokerage income is more stable. And Wall Street got frustrated because they weren't getting all the benefit of a lot of things going on with derivatives. So they fired this guy, brought in John Mack. He loaded up on a whole bunch of the derivatives, ultimately led to the housing crisis and led Morgan Stanley stock to get cut by 80% like everybody else. The point is that when the whole crisis was over, they went back to that strategy again, and that's why right now the stock's done so well is because they've gone to the stability factor. And on the heels of what Anwar was talking about, that you can have a company that goes into a new business model that may not necessarily have higher margins or higher returns, but if it creates more stability, don't forget the other side of what we're doing is not just looking at the return, but the risk. And if you can find something that's going on in your company that's going to make it less risky, into this idea of having software as a service, and you're therefore going to have a lower beta over time, that can have a big impact, especially if you're doing DCF, can have a big impact on your valuation.
All right, next up, we've got Joe pitching us. I think you might be pitching us a buy.
I am pitching a buy.
Wow.
I am Joe Anason. I'm a senior in the program. I am pitching Bioceres to be added to the International Materials Fund. Just quickly on how I found this. I found this through a news article on they have a new technology on their seeds that are drought tolerant, and they just recently got approvals, major approvals over the last year, and they're the only ones that have this technology. So there's a major moat and a pretty big market for this. So where I I believe, deferment on the street and stuff. So the street is pretty optimistic in their sales, and it's very, it's hard to forecast out these sales for this new segment. However, where I'm different a little bit, I believe that the street is missing the short-term efficiencies and the distribution network that Bioceres has created over the last few years, and they haven't really talked too much about that distribution network. And I think they're going to be able to leverage that a lot better than what they currently have, or what the street is talking about.
I'm confused. You said the street's too optimistic, but they haven't caught this thing. What are you trying to say here?
So they're optimistic in their sales, but I believe the underlying efficiencies, I think they're missing on like some of the synergies from the different.
So bottom line, and we'll get to Basil or Dr. Valentine next, is there upside or downside in the stock from the street? Are they higher than you? I don't, again, I come into these pitches knowing some things. I try to play a member of the audience. Right now, I'm super confused whether the street's higher or lower than you and when and all that.
I'd like to just follow that. So
Yep.
that's my question. Can you get real clear on this and tell us where are you relative to you and consensus for 24 and 25? Because it's on page 1. I want to make sure I'm.
Yeah. So I'm for the next in the next 12 months, I'm above consensus on EPS. 25, there's a major discrepancy where I'm below EPS compared to the street.
Do you know how much? Can you just tell somebody?
I'm at $1.14 for EPS. The street is at $1.56.
Okay, so you're substantially below.
Substantially lower.
Okay.
So do they have more upside overall in their projected price as a
Yeah,
result? Because they have more in their terminal value, I'm guessing.
Yep. So their price target is at $25. I'm at 15.
Okay.
So.
And is that affecting, are you pitching us, let me try to get this out of you, a
Oh,
buy based on any kind of time frame, or is it just a straight up buy?
Yep. So I would buy, but I'm having to recommend sell within 2 years. So I believe that with the discrepancies that I have with the street, is that I believe they're going to perform better in the next year to 2 years. But then I think the street was too optimistic in year 25, and that they're going to have to revise their EPS downward after that. So by that time, I'm recommending to sell around that point after like a further review if there has been any other material change.
And when will we know when to stop buying and then when to sell?
I believe there's going to be a big indicator in about 6 months, because right now, what's the time frame? The HB4 soy, the new soy seed, will be coming in effect this winter into spring. As those planting seasons coming up for that. The HB4 wheat won't be coming up until there'll be a little bit coming into the spring, but I think the big factor is going to be their beginning of their 24, because they're June ending. So within 12 months.
So the beginning of their 24, what will be the thing we can look at to know if we should be looking to get out?
You can look at the sales for HB4, the soy. So basically the soy seeds, if those perform well, I think it's going to tailor on to the wheat sales. And I think there's going to be a good correlation.
And what is well? Can you quantify that in your write-up for us? Right?
Yeah.
If we're going to pitch a 2-year hold on something, I think Dr. Valentine's point is salient. We need to know what our trigger is. And so could you tell us what the sales number is we're looking for that kind of is a make or break number, where I assume what you're saying is you might be wrong and the street might be right, and we have a lot more upside in that scenario. Is that true?
Yeah.
I'm not trying to put words in your mouth, but I want to make sure I understand things. If HB4 sales are higher than what you think, then we should keep holding the stock.
Correct.
But if they're lower or at what you think, we got about 6 months to get out. Is that fair?
I believe so, yes.
So could you help us like quantify that number as part of what your recommendation is?
Yep. So let's see. The percentage growth I had was a 20% growth in this revenue segment.
Oh, I don't need it right now. I actually want you to follow up with the
Oh, yeah,
class,
I'll follow
because
up on the polls.
if we're gonna hold this in a portfolio, we need to know that information. to manage it. Yep,
Follow up on
all
that.
good. Yeah, I don't expect that level, but thank you. Now, we've waited forever.
Yeah, I realized that your operating margin is growing by 8% within the next 3 years. Can you please like walk me through why?
So what happened right now, the operating margin for 22 is actual for that. That got depressed quite a bit over the last year because the company had a lot of one-time expenses regarding the launch of this new seed that they're coming out with. So that'll be taking effect. So I have that cost carried over to next year as well. But after that, that cost is, like I said, a one-time expense. Once it gets launched up, that cost should disappear, and I have that slowly easing out to have that operating growth.
Got it, thank you.
I have a question with your insider holding.
Yep.
It's pretty, or it looks pretty high, especially in the industry. Can you touch upon that and whether you adjusted in any of the numbers or your risk premium?
Yep.
Yeah.
Yeah. So yeah, the current insider holdings for those who are not, I believe, is about 52%. 48 of that percent is by the parent company of Bioceres. They're basically, you can kind of view this as like kind of a startup company essentially, and typically with startup companies, you have high insider holdings just so that the founders of the parent company can maximize their gains on that. I don't have any major concerns with them having that much, just because it gives them a little bit leverage in their negotiations, and just if they're going to capitalize on that, I mean, that means that we're going to capitalize as well. They're going to do on that. Did that answer all the questions, or do you have opportunities?
Yeah.
Who are some of their main customers, and can you quantify like how recurring that revenue is?
Yep. So their main customers are going to be like farmers that are going to buy the seeds or the insecticides or the fertilizers. And then they also do a lot of licensing out of their technology. So they get a lot of contract royalties from that and licensing fees. A lot of it's just one example that they gave, I can give a specific number on. For their fertilizer, they had 200 new clients come on over last year for their microbeaded fertilizer. And their current customers that they had already, they doubled, I believe, was what they were purchasing. And you know, obviously with seeds, you have to buy seeds every year. You have to buy fertilizers, everything's recurrent on that aspect.
Margaret, thank
you. Great work. I was just wondering, could you talk a little bit about the competitive landscape? I know you said that there's a big moat. I was just seeing that you included a comp table. And could you just talk a little bit about that and that inclusion and just...
Yep. So the big moat, it's a competitive area because there's a lot of companies that are doing chemical for the nutrition, the protection sides of it. The moat that comes in is that Bioceres is the only one that has drought tolerant technology for wheat for sure, and I believe for soy. And their technology is better than other drought technology that's applied to other crops. I can get back to that if you want me to. But they do have that patented. They do have a lot of these licenses was throughout other companies, and they have like exclusive rights to certain wheat genetic developers. So they have very good, solid network and maintaining that within their own control. If that makes sense. Yep.
And then could you talk a little bit about Cortiva? Is that like...
Oh yeah, Cortiva. So that was spun off of DuPont. So they're a massive large cap company. They also do seeds, and I believe they also do crop protection. So I put them as the closest comp because they have similar margins to what my company is. Obviously, they're two different stages of growth, so that's why I didn't use any of them for valuation metrics. I mainly put that in just to have like a comparison on like what the margins with the PEs are similar. If you go to, as Basil had shown me like a list of his peers he had pulled, a lot of their PEs, a lot of their metrics were a lot lower. And that's mainly because they don't have any like new technology coming out. Whereas, Bioceres has this new technology, this new seed coming out. So that's the differentiation for that.
Thank you.
I don't know if you know this off the top of your head, but how much more is it to buy Bioceres wheat seed than the normal seed? And how confident are you that farmers will pay this extra price for?
Yeah, I do not know the specific, if they have a premium on there. I'm assuming they do have a premium on their seed. So I can try to do a little bit more and get back to you on that aspect. But I believe farmers would, and especially the target areas that Bioceres is going after is more like the drought-ridden areas. And so the drought, the seed that they've shown that it can provide for the wheat segment can give 20% more yield and unideal or like bad condition farming, and 10% extra yield versus control.
And they charge a 50% premium.
I do not believe so. So that they can do that. But then the benefit to Bioceres technology for the drought tolerant that they put into it, that there is no compromise when the growing conditions are optimal. So like if this other Monsanto had a drought technology for corn and I believe one other crop, but what happened, how they did it, in ideal conditions, their yield was actually worse. So this kind of is like an insurance for farmers to like, they don't know what the farming season is going to be like. Let's buy this seed. If it's bad, we're benefit. If it's good, then we're not out anything.
Yeah, I think Margaret might ask a similar question, but can you touch on how long it took for them to develop this technology, how replicable it is, and how long that patent lasts for?
Yep. So for genetically modified technology, it took about 13 years for this to get developed, researched, deregulated, or not deregulated, but like get approvals for it, get it tested. So they started this back in 2008, I believe. Then for their other technologies, it's shorter. I believe it was 5 years for protection and 7 years for like their the nutrition segments. And then to replicate it, they do have the patents on it. Granted, some areas of patents might not be as strong, but to replicate it, it's fairly heavy technical, and to get the approval process, another company could get like a drought tolerant technology, but it's going to take them that additional years before they can get that approved.
Andrew.
Hey Joe, great job. So I know you mentioned that it's kind of like a startup company, and I'm just looking at some of their like income, and I see that in 2021 they had 6 million in revenue, but the year before that in 2020 they had negative 5 million. Some of the things swinging are like income tax, which has like a 550% growth. How are you confident that it's going to continue growing positively versus like continuing some of those downswings?
Yep. So I think they had a couple of large tax bills, as you probably see, where in 21 and 22 their tax bill was actually above their net income. And I believe that was from like they had some tax deferment. I forget the correct terminology on it, but those came due. And then Argentina has a couple other, they're changing up their tax laws currently. So there's a little bit of a risk to that, but I believe I have that accounted for my WAC and risk premium. Going forward, they do have a pretty, right now I believe they're holding about 100 million in cash, so they can take the hit on the tax aspect. And they do have high margins on this new seed technology. It's about 50 to 60%. And then the overall gross margins are about like 40% historically. So I believe they're going to be generating enough cash to cover. That.
Thanks.
I have another question. So with the war in Ukraine, and Russia, they take up 25% of like global wheat, grains.
Yep.
How would that affect, I guess, your sales with this company globally? Because I know that this company has 76% of its sales in Argentina. Do you expect this will increase due to the war, especially with their net export? Do you have any thoughts on that?
Yeah, so they did touch a little bit on Ukraine. So basically that is going to help them with pricing power. So like farmers are going to have a little bit more incentive to export like Argentina. Other parts of the country or of the world are going to have to produce more. So like according to like their target areas of Australia and the United States. So those are susceptible to drought, and so like this will help boost like the yield if those are bad. And so I don't know if I'm quite getting to your point here.
Okay.
Can you rephrase?
I was wondering how I guess the sales will be impacted. Like the total sales at Argentina will be around 76% of their sales. So with the war going on, and you just I guess expect the sales to increase because Ukraine and Russia supply 25% of grains globally, right? So now they're in
they're
war.
being limited.
Yeah, right.
So that would definitely have a positive impact as like other countries are going to have to pick up a little bit on the exporting. So yeah.
All right. Thank you. Next up, we have Ryan.
So
Covered and what are some of the needs to be.
So I'm Ryan Kreie, I'm a senior in the AIM program, and today I'll be pitching Fortune Brands Home and Security with a price target of $65.57, representing 14% upside. To kind of get into my screening process, I was looking for a company that had some financials, so over 5 years old, positive EPS growth the past 2 years, positive ROAE and IOC. It pays a dividend, and I was looking for something with a lower beta, especially given that we might be going into a recession. And how I differ from consensus is how the street is kind of predicting this spin-off that the company is doing. So basically, the company has 3 segments. There's cabinets business, water innovations, and outdoors and security. And they're planning on spinning off the cabinets business into its own stock. So basically, we'll end up getting 2 stocks out of it in a tax-free transaction that they expect to take place in spring of 2023. And a lot of analysts, I believe, are kind of writing off this cabinets business, thinking that, oh, they're separating it off because they think it's bad. But I actually, after listening to some management calls and stuff, I think the company just wants to kind of better allocate and have more management kind of attacking the cabinet separate from the rest of the business. With the housing market also, I think analysts don't really realize that the company is more exposed to the remodel market, especially those 2 sectors that aren't being spun off. If you look at the last graphic on the 4th page of my write-up, it talks about LIRA, and basically it's the remodeling spending projections. It's like an institute that Harvard has. So they actually project that revenues from remodeling is going to go down in 2023, which is part of the reason why I'm pitching a hold today.
So awesome. Can I ask a question? So you have a hold rating, right? And at one point, I think you were more optimistic about it. Can you walk us through why you're concerned about why would you screen like you did? Because you sound like you're very methodical about it, and wind up having a hold rating. What do you think holds you back?
So I looked back at some comps just because the company became public in 2011. I looked at the last recession, and I saw that comps took several years to recover from the recession, especially in terms of earnings estimates. And I see with my company that earnings estimates are still being revised down. We're not quite at that inflection point. So I'm thinking that once we kind of see those earnings estimates start to optimize, then it might be time to be more of a buy. But right now, I think we could be still kind of on the downward path.
So and I just want to hit on this for a second, because sometimes I'll have students come in and say, I want to pitch a stock. And I go look at the chart, and I can see the red line, which has been going up for years, is doing this and starting to do this. And I'll point to say, why are analysts lowering their numbers? And the student looks at me like, I don't know. And this is super critical. So if you've got that, now the other thing is that we shouldn't just buy stocks with the lines going up, right? It's okay to buy stock if the earnings are starting to going down, as long as you have confidence they're going to kind of bottom out. But as Ryan pointed out, I think he's kind of hiding some of the work he did. He did some really good work. He showed that like 2 of these companies we looked at, it took like 3 or 4 years after the Great Recession before their earnings got back to higher levels. In fact, so one didn't get back; they just stayed down. So the point
especially
is
their biggest competitor, Masco, which competes with 2 other segments, took over 3 years.
So the key thing here is if you're looking at economically sensitive stock, especially one exposed to the housing market, where we've got interest rates have gone up and home mortgage rates have doubled in the last 6 months, you want to go back and look in the past, go back 10, 20, 30 years and find out what happens in those down cycles to see how bad it could get.
Yeah, but I think kind of the biggest thing with this company is a lot of that's already been factored in for the next year into the stock, which has driven it down so much. So it is somewhat attractive, but I think we're still kind of on a downward trajectory a little bit here.
Yeah, and that's, I admit, when I was pulling Dr. Valentine aside at first, again, looking just like a student, I'm like, he's pitching 15% upside, telling me it's a hold.
Yeah.
I love this approach. If you are going to go with a hold, we've had 2 examples where I'm like, okay, I kind of get what you're telling me now, right? You're saying, hey, this is a cycle. Who's a double major in real estate? Love our program, absolutely do. I worry a lot about the future with that hat on that you have. I'm super happy you have 2 hats on. You got an AIM hat and a real estate hat. I love the real estate program here, but I hope they're telling you guys, it's about to get real rough in that market. And I hope we're being honest at Marquette about that, because it is, right? This is a cyclical business. We've seen this before. When interest rates get this high, it isn't just housing that gets hit. All of real estate tends to get disrupted. And so there's a high chance that even though you found a great stock, we're going to find a period where earnings get revised downward, and we're going to have an even better buy at some point, which is kind of what you're trying to save us some pain in between, which we appreciate. Thank you. Questions? What's the disruptive thing, by the way? Is it that alone, which is awesome, or is there something else you did, like outside the box?
Yeah, that was the main thing. Yeah, and then I kind of dove into each of the segments a little bit and kind of saw kind of management's kind of outlook on them.
Yeah.
So basically, the cabinet is kind of a more cyclical business, more exposed to the new housing market versus the remaining. I just call it the new Fortune brand. Is less cyclical, higher margin, and has a lot less debt than the cabinets business, which I think is what's holding the rest of it back from kind of growing more. And the company's made 4 acquisitions in the past 3 years, mainly in those 2 other segments, not in the cabinet segment. And basically by getting rid of the cabinets business as its own thing, they're going to free up a lot of debt to make acquisitions and kind of grow their brand that way and more inorganic stuff.
Yes, sir.
Inventory is up nearly 40% in the last 12 months. Is that a result of people pulling back purchases? Or
that's mainly for hedging against raw material pricing, which has also led to debt. And they've added 2 of their acquisitions they made this year have kind of some increased inventory levels as well.
Sorry, what was the first reason?
Raw materials.
No, what was your first?
Yeah, the raw materials. They hedge against the raw materials pricing by kind of buying up more inventory in advance.
Oh, I think
especially with the cabinets with lumber and stuff like that. So
yeah, because if they buy a hedge position, that shouldn't affect inventory, should it?
Well,
it can.
If
they're just buying it up in
that's
advance.
my question. If you go to the market exchange and you get some lumber futures or whatever it is that they use for the input, you put that in as your inventory? You put it as a financial.
It's a hedge. It's down in comprehensive income, but the contract allows for delivery. People forget that.
Yeah.
There are companies who actually hold the contract to completion and then accept delivery of the materials, and because that's their core business. So typically they use it as a hedge, meaning it's an accounting hedge.
But yeah, sales are also kind of.
But there are but there are companies who then actually take delivery of the contract and it translates and becomes inventory. It transfers out.
But when that happens, it's no longer a financial instrument.
That's right. It changes from a financial instrument and comprehensive income into actual inventory and the balance sheet.
Okay, I was just trying to clarify because when he said a hedge, I thought I just want to make sure the students a hedge is a financial.
No, that's a great. This is a great question, I think, for AIM, right? I know it's accounting. Sorry, not accounting PhD. That's kind of every once in a while it gets nerdy, but this matters a little bit to your careers and it helps distinguish you as analysts, right? Hedging traditionally is done down in other comprehensive income, just like you see all those foreign currency translation gains and losses. And so when he says hedge, it has a specific meaning. It means the company is probably trading a financial instrument, trying to basically lock in some price stability on what they're ultimately going to pay. If they're hedging, meaning they're actually buying the physical materials from Jim in Asia, that's not hedging the way we would put things in a financial contract. That just means they're locking in their inventory contracts. Yep. So yeah.
Awesome.
Sorry for the. Yep. All good. Anything else? All right, we're off to a good start. Just a house reminder before our next pitch. Right now, there's a sign-up sheet going around. I know you signed one up. We had a couple people depart. If you're planning on departing early in pitches, please let Dr. Valentine or I know what you're doing. We're just going to do a quick check, an audit check on, like, we got another departure here, right? What's going on? Hey, what's that?
He's a sophomore.
Perfect.
He just wanted to see my pitch.
Awesome. No. But my point is, if you're planning on departing early, let us know, right? It's totally cool, but kind of keep us informed what's going on. No, those were in-house. So please make sure you sign the sign-up sheet because it's the one we're probably going to take a look at closer. Where is it right now? All right. Fair enough. Okay, who's up next? Alex. All right, looking forward to this. Why you should be smiling? I've been looking forward to this pitch all week.
All business.
All business. All right.
Tell us about the security pie.
Yeah, tell us about this thing. It's worth $80 a share, right? I don't know. I want to learn.
That's not.
What do you have going on?
All right, so I
Now,
got
Alex has put a lot of work into this, which is why I sincerely have been looking forward to you pitching.
Okay, well, my name's Alex Mastalish. I'm a senior, obviously in the AIM program. Pitching to you today, Cameco Corporation, ticker CCO on the Toronto Stock Exchange, as a hold recommendation. Kind of where that's coming from is I'm under consensus in terms of net asset value per share in fiscal year 2022 by about 13%. And then I think, or actually I know where I differ from consensus is I have a lower realized price on that uranium, about 4% underneath consensus, which I think is attributing to the lower net asset value per share for that year. And then I guess like the last thing, I guess like screening process. I heard Joe talking a lot about uranium last year and thought I'd steal his idea. No, but in all actuality, there's something that I had an eye on for a bit. And then a news article around the middle of August was talking about Gavin Newsom reconsidering his state and his own position that he was pretty adamant on shutting down the Diablo Canyon nuclear reactor. And I thought, okay, we'll see where this goes. And he actually pushed it through to remain that nuclear reactor open, citing some of the energy challenges that California has had, and citing it as a nice, clean, reliable stopgap. So I thought that would be a good kind of idea generation and something to look into to kind of confirm where spot pricing is and where the company sits.
All right, Joe, you got the first question you asked for it.
I know we talked about it a little bit before, but I didn't hear the full story, and I just wanted to clarify more on their acquisition that was kind of announced.
Yeah.
And what you found out about like stock pricing, how the market reacted to that.
Yeah, absolutely. So this is always a great part about pitching. On Tuesday night, right after market close, they announced two major moves. One, and kind of in correlation with each other. So the first being a secondary offering of about $650 million worth of shares. So about $29 million or 29 million shares at $21.90 per share. And then the second part of that, and that equity raise, went towards the payment of the acquisition that they're making into Westinghouse. They're going into a joint venture, 49% them, 51% Brookfield Renewable, and the whole thesis for the company and what management was saying was they want to be more a part of the nuclear energy process. Right now, they're just mining the uranium, and they're also a part of the uranium conversion, but this will get them more into reactor repair, reactor building, and kind of that sort of maintenance.
So this is showing that they're pretty bullish on the future of uranium. Why are we not bullish ourselves?
Yeah, that's a great question. So I am bullish on uranium. I do have uranium pricing increasing by a decent amount each year. I believe 12% in fiscal year 2022, in fiscal year 2023, 8% in fiscal year 2024. But I guess where my pause for this company comes in is, one, it's a highly volatile commodity. There's a lot of things that could move this, but yet I'm still bullish. But I would say the other part of it is, if you look at it from relative valuation, it trades at an extremely high premium. Depending on what index you're looking at, it's up to 200 times of a premium. So
two times or 200%?
Yeah, 200%. So a 2 times premium. Sorry, good clarification.
So this company is trading at a premium. The street kind of expects it to trade at a premium. And as a analyst, but also as a portfolio manager in a way of this fund, I don't think it would be wise to recommend something that's so highly tied to a macro sensitive commodity that also fundamentally is overpriced and overvalued at this current time.
Valentine, then August.
If I'm looking at this right, it looks like you're at $1.02 for next year.
Yeah.
And I was gonna try to look at your 24 versus the street, but the consensus, and this is just another coachable moment for everybody. The consensus, when you drill down, there's one person that makes up that number. So be careful ever referring to consensus. But so I'm gonna use 23, so there's two analysts to make that up. They're at $1.23 and you're at $1.02.
Yeah.
Can you walk us through why they are so much more optimistic than you?
Yeah, just to be clear, you're looking at the Canadian, the .ca.
Are you looking in Canadian or US dollars?
No, I pulled up, well, I guess I can tell you whether I get the right number. I go back to you before. 21, 20, it looks like I'm looking at the same.
Same currency.
Your
Okay,
26,
perfect.
your 26 matches their 26 for 21.
Okay, perfect. That's yeah. So I believe there has been estimate revisions upward. I know the last time I checked it was 11.11. And
So
what was your question?
11.11. What do you mean by that?
Like $11.11 for EPS.
$11 of earnings per share?
Huh?
Sorry, $1.
Yes.
$1.11 of earnings per share.
Okay.
Previously, but continue. Sorry, clarify your
Well,
question.
24
So they
24 is
went-
24 is at $1.08.
Okay.
But what I'm more curious about, because that's one analyst, I'm more curious about 23, where there's a number of analysts. If we look at the estimates right now, they're $1.23,
Yeah.
and you're at $1.02.
Yeah.
So why do you think they're 20% higher than you?
It comes down to that realized price. I think that's what mainly drives the companies from top to bottom, right? So if I'm 4% below that realized price throughout the book, I could definitely foresee that being an area that could be underneath.
Okay, good. So it's fine. So is there a futures market on uraniums?
There is, yes.
And what's how far out does the futures market go? Like how far out does it go where it's reliable?
2026, but
It's not reliable.
I will also say that the spot market of uranium does not trade. If you look at
Well,
the
that's what
volume,
that's what
if you
I'm
look at the volume of it for the past, like, I think for the next future contract available, I think there's one open interest on it.
Let me retranslate the question.
Yeah.
By chance, did you measure the volatility of uranium trades? So one way, when we end up with it, what happens here is, and Dr. Valentine and I have preached to many of you and will, there are futures in almost every market you can imagine, which is awesome. But every once in a while, as you can imagine, I can't just go out and buy uranium futures. I can't imagine why they won't let me do that. They don't want me accepting thousands of pounds of uranium at my house, Dr. Valentine. I've tried repeatedly. It's weird. I've had all these NSA agents show up at my door. And so, but one can imagine why this might not be allowed to trade actively, right? And so to your point, we got this situation where it's very difficult to measure. The futures, if they trade, it's probably not a real trade because there's only certain people are allowed to trade it. And so one way we can look at it is say, hey, the volatility is through the roof, Dr. Wall, which is why you saw my price chart. It goes like this.
Right.
I don't have a reliable measure. And I don't want to put words in your mouth, but I'm guessing the street has a number and you discounted it because of the volatility. Is that a fair assessment?
I mean, that's a fair assessment, absolutely.
Okay, good. Thanks.
I will also, just to clarify, so a way that it's broken down in the company's financials and kind of companies across the industry, there's a spot price, there's a long-term price, and then there's a realized price. Spot price is what you would get on the open market. Long-term price is that they have through contracts, and that realized price is what they take to the book, minus that transportation and other cash, minor cash costs associated with it. So that's the actual price that the company will place onto their books. That's the book value of that price.
So it sounds like what you're saying is that this stock trade more closely to its price to NAV, like the value
Yes.
of uranium compared to like its fundamentals? And
Yes.
if it's at such a high premium right now, why is it not a good time to sell it right now?
Yeah, that's a good question. I think the reason there's a decent amount of buys and holds is there's a group of analysts and I guess the
So I
street.
don't think it was a question. The question is, should we be shorting it, right?
Yeah.
Why
Should
neutral?
we
Why? So-
short it? Should we be bold about short it? Why not?
I don't think we should short it because I'm confident on the price of uranium going forward. But I'm also saying it's a dual, it's a dual, I guess it's like an interesting place to be because on one hand, I'm very confident, Jack's pretty confident on the price of uranium going forward and the capabilities on it. On the other hand, financially it trades at a premium, and if we short it, but this thing's highly correlated to uranium and moves with uranium, then we lose a ton of money. So it's
If uranium flatlines.
if uranium flatlines.
No, I'm saying we lose a ton of money if the volatility dies down and it stays at the current price.
Right.
Or it goes higher.
Or it goes higher. Yeah. Because of the volatility of uranium,
right.
That would be another way to phrase it. If you've got a thing that's going, if your stock is tracing this thing that's kind of going like a yo-yo, you're probably not going to want to buy or sell unless you're really convicted as to one of the two. Is that a fair assessment?
It's a fair assessment.
Yeah. 3.
Thanks, great job. So I guess my question is maybe just about uranium companies in general, like for your downside scenario, if a nuclear reactor failure were to happen.
That was question 4. I should have jumped ahead. Go ahead.
Mine too.
I was just wondering if you could talk about like the likelihood of that happening, if any company would like.
Yeah.
Well, you didn't show that off on here, did you?
No,
He
I
put all
didn't.
this work into this super cool thing, so thank you for letting him showcase this.
So-
Please talk us through what that's
So
worth, by the
essentially-
way.
Can you repeat the question? Just 'cause I'm not sure what heard.
Nuclear reactor failure.
Okay.
What are the chances of a nuclear reactor failure? Because I thought, oh gosh, they're almost none, right? Which you quantified, and then how does that translate either into WACC or EPS in your company?
Yeah, absolutely.
Which you did.
So, which I did. So essentially what I took is there's a nuclear average age of life for a reactor, and it's about, right now, currently about 14,600 years. There's 3,
Oh, the life of a reactor.
well, not, it's like the nuclear average age.
No, it's the number of accidents per nuclear year,
There we go.
nuclear years in operation. So you've got, out of 14,400 potential years of
Hours.
nuclear, summing all of the current plants in operation, how many of them fail, are
3.
expected to fail? 3 out of 14,000.
Yes, correct.
How many nuclear reactors exist right now?
459.
So if you do the math, how many should fail and how long should it be on average before one fails?
Once every 9 years.
Which is what freaked me out. I thought it was gonna be like 100,000 years. I don't know about you guys.
I guess we had 3 over the last 30 years.
Yeah, well,
So,
but the math works out, right? It was like, holy cow, they kept telling us this is an aberration. It turns out it's not.
right.
It's actually predictable. And because of that, did you then attempt to quantify that somehow?
Yes, I added a premium
This is
onto
cool.
my WACC of about 100 bips.
How did you get to that?
I assigned a value.
I thought, well, wasn't there a scenario? Hang on, I'm gonna walk you through it because there's a
No,
little
no,
bit
no,
more.
no. So assigned a value into the WACC, but also I look back to the last nuclear reactor failure, Fukushima, which essentially chopped the spot price market in half of uranium and decimated this company's share price in half.
And so if you put that in, right, the probability, you put in what happens if uranium prices fall by half? It affects your sales. You assume margins are saying this company's output was they lost money.
Yes.
And then you put a probability on that happening once every 9 years. You quantify that, you come out with a new EPS, you then backwards that into a WACC. It turns out it's about 100 basis points. So we added 100 basis point risk premium for the chance in any given time of any nuclear failure, because even if it isn't his company, uranium prices fall. I think that's cool. I wish you'd show that off because I think that's pretty awesome.
Yep.
Yeah, that's super cool. Like that is something that will get you a lot of following on the street. So good job.
Thank you.
You stole my question. Good, that was a great question. 5.
Mine was pretty much the same thing.
All right, 6.
Did you look at like any sort of consumer or just like sentiment in general for nuclear energy? So I know there's a lot of, I guess, anytime somebody thinks about nuclear energy, at least for me, the first thing that I think up to is like destructive ideas. So I guess just what is the sentiment, or do you know anything?
Yeah, short answer is no, I didn't look at consumer sentiment. What I did look at though was the government sentiment, because that's ultimately what's really important is how are world leaders shifting or maybe not shifting their energy needs towards uranium. And like I said, it was definitely a catalyst for me of looking into this company was California, with a governor was very anti-nuclear energy, saying, we should maybe give this a try. Or in the recent months, Japan saying the same thing after being hurt pretty bad by the Fukushima nuclear meltdown after the tsunami and earthquake, for them to finally start to come around and say, hey, we want to give this another shot and reactivate these plants. I think that's a good sign for me in terms of sentiment.
Hey, Alex, great job. So I know that France recycles a lot of their like nuclear waste and stuff. So one article I found says that it reduces their need for like natural uranium by 17%. If more of the countries start adopting this kind of process to refine the waste, do you see that materially impacting the way you've like forecasted uranium prices?
So I didn't account for that, no. But I would say that if that were to happen, it would definitely hurt pricing a little bit in terms of the fact that it is a supply and demand. Quite honestly, it's a supply and demand game. Cameco's management has said that there's kind of a fine line of how much they want to produce, and that they will not flood the spot market with uranium as they did pre-Fukushima, because the net effect of that was pretty poor on the company. So I would say that if you're reducing an amount of demand, it would hurt the pricing a little bit.
Thank you.
Thank you. Next up, we have the man with probably the most complicated banking model I have yet witnessed, in a good way. Always a credit to August's brain power and good work on things. So take us away, August, and talk us through this exciting banking.
Yeah, I'll take that as a compliment.
First part was incentive.
Yes, I've been met you before. My name is August. I'm a senior covering domestic financials. This is my first time pitching a bank, but basically how I came about this and how I wanted to find value was I wanted to find a bank that was primarily a commercial lender. I didn't want any exposure to like the residential mortgage area or like too many consumer loans on its balance sheet. So I wanted to find a good catalyst for economic, what's the word for it? Momentum. And so what I did was I found the U.S. Census Bureau releases data on employee identification number applications by county in the country. And I found that among southern states, there's been like a huge surge of applications for businesses. And basically EINs are like, if you want to hire employees or like separate your finances like from your personal account for your business. If you want to establish a business, like you apply for an EIN. So there's been a ton of that in the South, and particularly in Missouri, Georgia, South Carolina, the top two, like 25% year over year. So from there, I wanted to find a bank that kind of fit my screening criteria, which was like less than 1 loan to deposit ratio, so that it had ample liquidity. It had a branch footprint that was pretty highly correlated with the EIN counties that were growing pretty highly in these states, and that it had a really small market cap, just like under $1 billion, that it could be a good acquisition target. And Colony came up as this company. So with that, I'll open it up for questions.
I was shocked to find a bank with, it looked like, is that correct? It's about a 60% loan to deposit ratio.
Yeah.
So were you surprised by that?
I was when I saw it, but I actually found that it's pretty common among like a lot of regional banks right now.
So are you expecting them to finally, right, they're allowed to go up in the 80s in the US and other places, and then overseas they get up over 100. Are you expecting that to shoot up right now, or has management indicated anything, or do you have any insights for us on their loan strategy?
Yeah, so in the second quarter, management guided that by the second quarter of 2023, they should have a loan to deposit ratio of about 70%. And my model also has this at 70% in 2024.
So if you look at a big bank, just to put it in perspective, they're often in the 80s, right, for this sort of thing. They're capped. They're not allowed to lend more theoretically than they have, but they kind of take it up as high as they can, which makes sense because you're levering and that's how you make money in a bank. August has stumbled onto a bank that has all kinds of room to make loans, and lo and behold, we're in an environment where those loans are going to be probably some of the highest yielding loans that they could have ever issued in their history. So I'm assuming this is part of, the street has probably captured this idea. Where are you departing from the street though? So you talked a lot to me about how you're like the street, and that was my pushback. I said, I feel like you're mishmashing the street. And then you said, but I did this thing and I don't want to spoil your thunder. Where do you depart from them, and why are you convicted about that?
Yeah, so in none of the sell-side reports, I couldn't find anything about EIN applications or really business growth in southern states. So where I defer is that I think there's going to be more loan growth than what consensus anticipates. And that translates to like 12 cents more in EPS in the next 12 months or so. So more loans is the answer to that.
Joe?
Yeah, so going on the loan growth and everything like that, do you know if the company, a lot of banks have a cap on how much they can loan to like one customer? Do you know what that cap is? Or if they ever I don't know if they would disclose that or not, but
I never found that. I don't know what the answer is to that. I can get back to you.
It becomes my understanding is it becomes part of their Camel score, which is kind of proprietary at the Fed, but they get a grade based on kind of like anything else. And we have the equivalent of insider holdings in stocks. They get a detriment the larger they all are in on one portfolio, but no one's privy to the exact formula unless you're inside the bank.
Okay.
Yeah. Do you know what their average loan interest rate is right now, or loan duration, any of those things?
Their interest rate's about 4.6%. That's what their yield is in the second quarter.
Yep. Question?
For their calculated average loan yield, is that net of like losses from not collecting?
Are you looking at my model
That you're attached?
No. It's not. Yeah.
Yeah, a few questions, sorry. So for number one, I would say, for the EIN research that you did, awesome research, by the way. Do you have any idea of like what kind of businesses are being started?
Not particularly in the South. I couldn't find anything that was like conclusive to like these southern businesses or like agriculture or retail or something. The census countrywide releases data that splits it up by some sort, not gigs, but like some sort of classification. But I couldn't find anything that like pointed to like everything in the South is this kind of a business.
But maybe to answer some of your questions, you did look at the employers in those regions, right? Who were some of the largest employers?
Yeah, so that was primarily to find deposit growth in more the longer term. A lot of the employers that are coming to building manufacturing plants between like 2025 and 2027, 2023, somewhere along there. Well, there's like Hyundai is coming, Rivian is coming, Jack Links. These are all going to create thousands of jobs, which is really good if you're a bank and you have a ton of deposits coming. It's giving you more liquidity to originate more loans and make more money. So, yeah.
Thanks, ma'am.
Oh,
sorry.
I said thank you.
Okay.
Oh.
Yep.
It was a great job. I was just wondering, I think you mentioned in your screening process that you were looking for something that could be a good, could be acquired. What do you think like the likelihood of that happening, and like do you see that in your time horizon, and then what would happen?
Yeah, so regional banks are a cool sector because there's over like 5,000 in the US, and like 4,500 of those have like under $1 billion in assets. So it's an industry that's seen like a ton of consolidation in the past. In the next 10 years, like it's probably going to halve. So it's very much so like eat or get eaten among the regional banks. And I think like this bank being under $500 million in market cap, like I think it's a good acquisition target, especially because it has like such a strong Georgia base. And like there's constantly acquisitions happening. So that's like a primary reason I chose Colony, because it is like such a small bank. So I don't have like an estimate of when it could be acquired, but I do expect it to be acquired if it stays at this size.
Do you have a rough idea of what regional banks get taken out at in terms of multiple?
Not in terms of multiples. Yeah.
So, and it's pointed out, right, and you probably see this in August, there's been a phenomenon, although I'm gonna depart from our analysts here, we can have a debate. There's been a phenomenon, it's tried and true, my ex-business partners have been riding this wave. August has correctly pointed out, it's been all the rage to start up a bank of any size. And the goal is you grow as fast as you can on assets, as fast as you can on loans, and you start another, and when you get to about 10, a mid-sized bank will take you guys over. And they, of course, are trying to package about 10, and the large banks swoop in and take them. And that's been a tried and true formula. It's been running now for 10 or 15 years straight. It's been working great. They've all been able to parlay up their assets. They're leveraging up their loans. They get priced right each time you move up in size of bank. To Dr. Valentine's point, the price of the book, the price to NAV multiples growing, so it becomes accretive. Just the act of acquiring has become accretive. And yet, in a high interest rate environment, the last time that happened, it didn't work out so well. So normally, although there'll be a happy ending here, I'd push back on your assertion. I think we'd have a friendly debate whether that, I worry a lot about that, because last time I saw a high interest rate environment, that imploded because all the banks were levered up on lower quality loans that were fulfilled in terms of their capacity to lend. And so now I've acquired 10 banks that are all at max. They're all locked in at 4% loans, and current interest rates are 7 or 8. In your case, they give you a free pass because you discovered this nice little gem that still can lend out 25% more. But something to cast some context on. Sure. Yes.
Sorry, some more questions for you, August. I'm looking at thank you for including this nice large context cost. In terms of your loans versus deposits, it looks like, well, the line that says County Bank applied deposits, that's like your deposit amount, right?
County Bank applied deposits?
Or Colony Bank applied deposits, it's like underneath like.
Oh, market sizes?
Yeah. So it looks like deposits are slightly outpacing loans in terms of growth. Do you have any concern in that area, especially with like, I know a lot of room for loan growth is good, but with high loan rates peaking at 7%, do you see that as an issue at all?
Yeah, so you're referring to like the market sizing part I have in my model, and that was primarily just to illustrate like what the market is for total loans and like forecast what loans could be in the future. More in the income statement of my model, or I guess in the balance sheet, which isn't attached. But I do have loans outpacing deposits, especially in the near term, because they reach like a 70% ratio. And then they kind of track each other one for one basically after 2025. So kind of maintain 70%. Yeah.
A great question. That is the risk, right? This company stays too conservative. This is the top. Interest rates come down, and now they've kind of stuck themselves the other way. They have all these deposits that they lock in certificates of deposits at higher rates, and they never capitalize. So I don't know if that was something you considered, but if management doesn't act soon, they run the risk of upending the business. Cool. All right, thank you.
So one thing I just want to call out that I think obviously did a really nice job with A, used the new template, and B, he's got a very detailed financial model. As I point out to him, you don't have to do it that detailed, but if you're going to go into any level of detail about the financials, that's part that justifies your stock pitch, you got to make sure your financials expose that, right? You did a really nice job.
Yeah, I actually told Alex I prefer him produce that level of detail, but for mere mortals, there's only about 5 to 8 lines that matter in a bank. And so while he went a little robust, and there's nothing wrong with that, getting it down to a model that you can compare all the banks against probably isn't the worst idea to just kind of derive one. That would be my one ask of you in the future as an analyst if you were to stay in the industry, because then you could really set yourself apart. Be like, okay, well, you want to go high or low? I got both. Sure. Yep. All right. Next up, Luke, walk us away to talk us through the normal stuff. You know, what do you got for us? And then especially, how are you departing? What did you do to make yourself a little different and valuable? Okay. Thanks.
My name is Luke Hunneke. I'm a senior in the AIM program, and today I'm pitching AMN Healthcare Services. AMN is a healthcare company that provides staffing needs for hospitals, such as like travel nurses, travel physicians, and different workplace solutions. And the main way that I
kind of different from consensus is so AMN just had throughout COVID, there was such a demand for travel nursing, and bill rates for these nurses skyrocketed. And so in the past probably 6 months, that's obviously come down, and consensus has priced that in. And so EPS for 2023 is much lower than what forecasted EPS for 2022 is. And so I come out a little higher than consensus on there. And through some of my research, I think that while bill rates will come down and nurses will not be getting paid what they got paid like peak pandemic, there will still be some demand for travel nurses as a lot of staff nurses are experiencing burnout as it continued from the pandemic. And I see that continuing, but not to the point to where I would push a buy currently.
So my question then is, you just told me you're higher than consensus, right? Is consensus fishing a sell or a hold?
I think they're neutral.
Okay, fair enough. So consensus is a neutral. You're higher than them by how much?
50 cents in 20, I think next 12 months.
So 50 cents on a $9 earnings, right? So that's significant. So you've got 50%, or is your expectation that this, I'm trying to understand, Dr. Valentine is saying, is your expectation that the consensus is going to have to downward revise, or are they kind of flat? Or they, you know, you say they're too conservative. I'm trying to understand, are we in a trend where earnings are going to keep decreasing and consensus is going to have to keep decreasing? Or are we in a trend where they've got it right? Or I'm a little bit lost, right? Because normally if someone comes to me and says, hey, the industry is going to get hit, everybody knows it, and I'm 50 cents higher, I'm 6% higher on my earnings forecast and far into the future than the street, I thought, normally I'm thinking buy. So what am I missing? Can you help me understand that?
Yeah, I mean, that's where my thought process is at, where consensus, I think is just a little too low, but I think in all my modeling and research, I just didn't get enough upside to where I felt comfortable to buy.
So was the value more valuation then?
Yes.
Okay, so that isn't enough. It turns out when you model it all, consensus, if they were being honest, might even be a sell then. They're at the lower end of a hold, let's call it. And you're kind of at the upper end of a hold.
Yes.
Okay, fair. Thank you for helping me understand that. What is the special sauce you put into this? Is it what you just did there? What is the secret sauce? What did you investigate? What did you do to make this flukes?
Yeah, so some of my proprietary research I did was I surveyed some Marquette nurses.
Oh, there we go. How many?
27 Marquette nurses.
Okay.
And they kind of helped me understand what's happening in these hospitals. So you have, a ton of staff nurses who are quitting and becoming travel nurses. You have a lot of hospitals who are not confident in kind of these staffing shortages turning around. And so that kind of helped me formulate some of my investment thesis.
So what did it help? What question did you ask that you, so here's where you're going to find I start pushing a little more. I love what you guys are starting to do with surveys. We talked about the idea we'll fund you for these things if you want to talk to us. But now that we're starting to ask them, kind of like last week, right? I pushed back and said, okay, you're getting close. Did you try to quantify any of that? Is there a question that led you to be able to quantify something in what you did?
I think to answer that, not specifically, but to be able to get an idea of the amount of demand for travel nursing that will be in the next 2-3 years. I think what surprised me the most about my survey is a lot of the nurses I surveyed were interested in travel nursing, which I think, at least for me, I would much rather, live in one place and not be.
Did you read any reports or read any news articles that suggested that nurses weren't doing travel nursing or were doing it at a very small level or weren't interested?
Are you talking about
even before or after any point in your research process?
Can you rephrase?
So what I'm trying to push you to do a little bit is, and you may have done it, is if I found out that I was surprised that I interviewed 27 nurses and 25 are interested in travel nursing, and I think that'll have a positive effect on my company. I normally want to ask a couple more quantitative questions, but that's the problem of surveys. I forgot to ask something. That's okay. I probably then would pivot and start doing the Dr. Wall tried and true blind man's wandering through Google, looking to see if I can find any news stories or any research or look at my analyst reports talking about if there's any demand in general or stories written about this travel nursing phenomenon to see if a lot of other nurses are saying the same thing, or no one's talking about it and I'm onto something? Did you do anything like that?
I think both of my research was that staff nurses are quitting. There's a lot of burnout. And
You think you discovered why, right? Maybe.
Because hospitals are paying them enough and
now they can do travel nursing.
Right, where they get paid
So
more.
my hypothesis is travel nursing might let them get paid more, and that could be a reason why they're quitting that no one's seeing.
Right.
Did you then go out and Google search on travel nursing just to make sure no one's seeing that?
Not specifically.
Okay, that would be the thing I'd ask you to finish off, right? You guys are, once again, we're so close. You got a great hypothesis, you got a great finding. Now just go double check. The analyst group isn't mentioning it. You're not really finding any stories about it in the press, so to speak. And you probably have something you can start running with. Pretty cool. Yeah.
Is there like a breaking point in terms of when it becomes like for a hospital or maybe like an elderly care facility, whatever facility that's housing nurses, where almost too many travel nurses becomes a problem and the wages start to diminish because they can't offer them, like if half of their nurses are travel workers and travel nurses and half are like fully on staff, at what point do you like forecast, and maybe that plays into your view, where like it just like travel nurse premium dissipates?
So like in the view of a hospital, that's when I think, if you say you have like 80% travel nurses and you have 20% staff nurses, that's when I would start paying my staff nurses more as a way to kind of, so you don't have to pay as many travel nurses and you can kind of keep the culture the same, where you have the same people working.
What is the split right now, ish? How much travel to regular?
I mean, it depends for every hospital.
Any rules of thumb, right? You quantified one side, so I'm with Alex. I'm just trying to get some real rough ballpark of what is, do you have any, is it like 10-90, is it 50-50?
I can get back to you.
Okay. August.
What's the story with revenue in 2023?
Yeah, so that's just bill rates for nurses are plummeting, and there won't be as much demand from hospitals for travel nurses.
All that COVID triple overtime going away, is that a fair assessment?
Yes.
Yep, go ahead.
So how many people right now have got FactSet open and are looking at the G10 chart? I see one. So this is something that, at least when I was in a Wall Street firm, if you were doing a presentation and people had computers around them, they all had the stock chart up when you were talking. And one of the things that I would just point out that I find just fascinating about this is that if we go back to, you look at the, remember the red line is next 12-month earnings, the orange line is the 12 months after. There should always be a gap, right? You should have some kind of growth between year one and year two, right? Well, for this company, that was the case for about eight years.
Absolutely.
But then all of a sudden you got, in February of 2021, they crossed, all of a sudden they became the same line. What it tells us is that the street said this company is not going to see any more growth. Well, guess what? They said the company's not going to see any more growth back when the company was expected at $3.91. Right now, they think the company, that was what, 2 years ago, they now think the company's going to earn $9. So what does it tell you? And by the way, they still have, they got even worse where they start saying the company's going to have a down year. This is where the street keeps on saying we're going to have a flat year over the next year, and then I'm going to raise my numbers. No, we're going to have a flat year. Oh, I'm going to raise my numbers. And so this tells us a story, and that's why I would strongly encourage you to have this chart up and just try to figure out like why, like this jumped out at me because I'm like, why is the next 12 months higher than the 12 months after that? That's pretty rare, and it's because of it sounds like a.
Oh, sorry. It's page 22 for the juniors of the write-up, sophomores, underclassmen who haven't seen your G10 chart. He's got it in.
He's got it in his write-up. If you turn to page 22,
yeah, good,
he's got the chart that Dr.
So that way
Valentine's
they can
looking at right
understand
now
what
is
we're
on
talking
page
about.
22.
Awesome, fantastic. Yes.
Yep.
And so you'll see that orange line normally in the back is the earlier periods is higher.
Should be higher.
Should be higher. So all I'm trying to say is that when you come in the room here, bring your laptops or log on the computer here and try to have this G10 chart up. This G10 chart didn't just come out of my head one morning. It's something that evolved over 30 years. And these three panels each have a key element that can often, not always, but often tell you some important things like this.
Anything else? All right, well, thank you. All right, last but not least, Kevin.
another one.
Come on down, talk us through Nova, tell us what you're disrupting and kind of take us from there, if you could, please.
All right, hi everyone, I'm Kevin Igoe, I'm a senior in the AIM program and I cover international tech. Today I'm pitching Nova Ltd, an Israeli-based company that provides metrology solutions for the semiconductor manufacturing industry through dimensional metrology, materials metrology, chemical metrology, software solution and services. And I'm pitching a hold. Price started $76.42, with an upside of 2.78%. I guess my screening process to go into it, I just looked for a company with positive sales growth the past 5 years, positive EPS growth last 5 years, and a forward PE of under 20 and a healthy balance sheet. And I came across Nova. I liked some of the drivers. And then how I differ from consensus. I think consensus is a little optimistic following management guidelines. A lot of people are excited about their plan to double revenues to $500 million in a couple of years, and $700 million set aside for mergers and acquisitions. But since they went public in 2000, they've only made 3 acquisitions. And I think their most recent one of Anason was a great addition, but I'm just not as confident in management because they don't really have a track record of any proving everyone with their acquisitions. So I guess with that, I can open it up to questions.
So my question will be, knowing what you know now, when we start talking about screening, realizing that maybe just quantitative screening on PEs and stuff won't work, how would you approach this going forward in your next pitch? What would you do different? So how would you try to screen for a disruptive item?
Well, first of all, I guess I'd definitely look at the G10 chart first for any company.
Well, what do the G10 charts tell me? No offense to Dr. Valentine, but if that's been out 30 years, I don't feel like I'm going to get tremendous value out of it.
Hey, I didn't say it's been out for everybody. It's my proprietary chart.
I think it's awesome, but no offense, knowing this company went up 3-4 is awesome, but I don't know that I'm departing from the street. So it's a good start. How do I help me understand? How am I going to use this G10 start to screen? I want to start screening with Dr. Valentine's G10 start. I'm going to push back. We're going to learn. Dr. Valentine can defend also.
Well, just so I can split the argument discussion here. There's 2 ways to, well, a lot of ways to screen. One of the ways is to go through and say, right here and now, let me screen on everything I know about the company. The chart's not going to do that for you. But the other thing is that once you narrow down to 3 or 4 or 5 stocks, looking at this chart can tell you a lot about.
Oh, totally. But he said he's starting with your chart, so I'm trying to.
Well, and I do tell the students, I say, what I told the students is that don't start to go and do all this proprietary work until you look at these kinds of things, because you might find that like earnings have been going down for a year, and you don't want to spend a lot of.
And that might be your answer, right? I accept this thesis. You might say, I'd look at all 15 companies and look at Dr. Valentine's chart, and I can see that I'll be able to see that 10 of them have kind of hit that red line and start going down. I'd shut up at that point. You put me in my place. Right now I'm down to 5. Well, I'm going to come back to his chart later, but okay, let me take my piece. So go ahead.
Yeah, so I'd go to the chart with a couple companies narrowed down in mind.
Okay.
And it'd show me where they beat earnings, where they didn't. I guess I could go back through historical years to see what factors influenced them not beating earnings or beating earnings, and then it'd show me how they're doing relative to the market.
But hopefully those 2 companies you walked in with something that you really loved about them that you were hoping not to see in all these write-ups, right?
Yeah, I guess it could just back up
Awesome.
or change my mind.
So what did you do different this time? Understanding that the screening process didn't lead you down that path, and that's what got us to a hold. What did you do that kind of made your value still pretty cool to this hold? Did you do anything extra outside of the normal process that you could highlight for us?
In my screening process?
No, just in general. Like, you just pitched us a hold.
Yeah.
You walked us through how you differ from the street a little bit, but generally you're at a hold, right? What did you do that's different and disruptive? Like previously we had a guy that did a survey. Previously we had this uranium thing. What did you do?
I didn't do any alternative data research, but I guess I just looked at, because I feel like the street was closely aligned with everything management was saying. And then I guess I just looked back, like I said, through their mergers and acquisitions in the past. They really haven't done much, so I'm just not as confident in them and their ability to make the right decision.
Well, if I'm gonna push back a little bit here at the end and say, with all of you, if you end up at a hold, because the screening didn't work out and you feel that the street is kind of mirroring management and you don't know that you trust their mergers, and that's okay, pick something. If your picking point is, I don't trust their M&A strategy, try to quantify that and show off that skill. In other words, if you're coming out of AIM, Dr. Valentine, I expect there to be an appendix that shows off something. In your case, it doesn't have to be this. It could be anything you just mentioned. But if I said, gosh, my hypothesis is I don't trust management because their M&A strategy never plays out, then I'd hope I'd see an appendix A that would show me deal after deal where management made a statement and then things they did didn't match what they told me they were going to do. That would be a nice way to start. Is that a fair assessment? So that I'd love to see in your next pitch something where you kind of add value that way. Not a criticism right now. We're all going through learning curves, but that would be awesome.
Yeah, because it's hard to find buy stocks, right? Buy rated stocks in big where, especially when you guys are in college, you got 3 or 4 other classes going on, a lot of other things going on.
Oh no, they can't.
And you're trying to go in and find, screen a stock. Up to this point in an industry, sometimes it has got 6 or 8, 10 sub industries. So we're not trying to suggest like this is an easy thing to do.
That's right.
But if you get to the point where you're like, you know what, I have a tough time putting a buy rating. Well, then tell us why you think that the bulls out there that have the buy ratings on there, because almost every stock, 80% of stocks are going to have a majority analysts or buys. Tell us what you think they're missing. There's something that shows the critical thinking skills, because this is what, when you're sitting across the table interviewing with one of these firms, and they say, give me a stock pitch, and you walk through, they're going to want to hear what you did that's unique. And that's what we're trying to pull out.
Yep. Yes, sir.
So I know very little about the semiconductor industry. Can you just explain to me what metrology is?
Yeah, well, it's just what goes in. It's like, they sell their products to the companies that make the semiconductors. I don't really have the perfect definition, but the machines basically use positive, negative ions to add different base layers to the final chip. And then I guess like the chemical metrology, which is new to them with the acquisition of Ancosys. That's more the back end part of the semiconductor manufacturing, which is like packaging and cutting the wafers into the final product.
Just, it did sound like you knew what you're talking about. So don't start off by saying, I'm not really sure about this, and then give some really detailed answer like that. Just give me a detailed answer.
Do you know what the equity risk premium is for Israel, and is that US?
It was 0.7 according to Doran, but I used a 50 basis point.
Why?
My WAC. Because I also factored in that China is like their biggest revenue generator, with 57% of revenue coming from there.
What's China's equity risk premium add on?
I'm not sure with that.
So again, I'm going to put you through a little logic test. You know where this is going to end up. I'm not going to try to torture you too much. I had a 70 basis point risk program when I moved to 50 because most of their money comes from China. Wouldn't the logical follow-up just be to check in on China and make sure it's zero? It's totally cool if it is, but I kind of expect you to know that answer if you're going to depart on a quantitative basis. Fair?
Yeah.
Yep. Oh, yep, sir. Yes, sir.
Can you just talk about using the market multiple for your valuation? I just haven't seen anyone do that yet with the 15.1 times.
Yeah, definitely. So with Nova being an international company, I was between using, I talked to Dr. Valentine about this, I was between using the S&P 500 or the iShares US X ETF for my relative market. But I calculated my beta compared to the S&P 500, so I chose to do that. So what I did is I took my year one EPS, estimated EPS, multiplied it by 25%, and then multiplied my year two by
25% discount, right?
Yeah. Or no, well, I'm getting into my PE, but I did 25% because we're already through.
Oh, sorry, it was a year. Sorry,
3 quarters, and then 75% of the next year. And then for year two, like months 13 to 24, 25% of same year, and then 75% of year 3 EPS. And I did the same thing for the S&P 500. And then I got my PE for each one. Took my PE divided by the S&P 500 PE, got a 6% premium, and then multiplied the market multiple times my premium and got a target price of $77.47, presenting 4% upside.
Did that answer your question?
Yeah. Thanks.
Because one of the things we're kind of torn with is that what market do we use and what percentage of the business is actually in Israel?
It's like 0.5%.
Yeah, so like
You said it's 57 China, yeah.
Yeah, so the question is, do you use like a global index or do you use the S&P 500? Because you can also argue that, you know, AMD and the other US companies would sell a lot into China, or at least they used to till today or this week. But so it brings up an interesting, I guess you could say, debate on how much country risk. Do you take the country risk and where you're headquartered, where your exchange is, where your customers are, where you have the most exposure? I think Joe's company, they're down in Argentina, but they report everything in US dollars. Yeah. Because most of their customers, they charge US dollars, right? So, you know, then the question is, well, if you have a company that's global and everything's done in US dollars, then do you give it a Argentinian discount or a higher equity risk premium? I don't know. I mean, that's something, Oswald DeMotor in his book talks extensively about this, but even he'll tell you that there is some subjectivity to it.
Yeah, depending on how crazy you want to go with it. I got a couple of you have created stuff like weighted average type betas or things, right? Where you do some stuff. I think that's pretty cool. I have to tell you, I used to create my own to this high low, which one's stronger or weaker. I used to create my own subset of betas relative to the index or industry I was following because I thought that was a better measure of who's strong and weak within that subset. And there's nothing wrong with that. You all know how betas are so easy to create. We would encourage you to play with those, and that could also be an appendix. Hey, here's my S&P 500 beta. Here is my soft drink beta, right? Yeah. And here's all my comps. I think there's a lot of value in looking at the world that way that goes undiscovered a lot of times, and it's an easy thing to do. Yeah. So if you want any help on those things, reach out. We can do it in 2 seconds. It takes no time. Anything else? Look at that. We got done in under 2 hours. There's a second sign-up sheet that moved through the room. Did everyone sign it?
It's right here.
You didn't. Please make your way over there and get it signed.
I'll bring it up by document.
So we are selling.
Sign-in's right here.
It's so